Hello friends, how are you? I hope you all are doing good. So we are going to continue with marginal costing and marginal costing. In the last lecture, we were discussing about the break-even point, a very important discussion, right? And we also discussed about the CVP analysis in the last lecture, right? And this part we have already covered, basics, contribution and PV ratio. CVP analysis, I hope you all have understood very clearly, and the break-even point that we started, right? And we'll be completing in this lecture about the break-even point. So before we continue, subscribe to the channel, press the bell icon so that you get all the notifications in time. And most importantly, share with all of the people, guys. We really need a lot of support from you guys in creating this awareness that quality education need not be costly. We always say that quality education need not be costly, and you people can play a very significant role in spreading this thing, in sharing by sharing with all your friends on all the platforms, on Telegram and everywhere. You people can share, right? You people will have to play a major role in this thing. So we really need a lot of support from you guys. Okay, so coming to the topic now, break-even point. We say that break-even point is that level of sales where we are neither earning the profit nor incurring the losses. Total sales is equal to total cost. So this is what we discussed, the various formulas for the break-even point. At break-even point, total contribution is equal to total fixed cost. That is why the profit is zero. This was the validation I have given through income statement also, right? So after that, we have discussed the various formulas for break-even point, that how we can calculate the break-even point in the units. I have given you the derivation almost. So break-even point in units is fixed cost divided by contribution per unit. Then if you want to calculate the break-even point in value, then fixed cost divided by PV ratio, or this can be written in various ways. Break-even point in units multiplied by selling price per unit, fixed cost divided by contribution multiplied by selling price, or fixed cost divided by PV ratio. All these things mean the same thing. After that, break-even point in percentage we have calculated, that is break-even point by total sales multiplied by 100, right? Then we discussed about the total fixed cost having two parts. One is the cash fixed cost and the other fixed cost, which is notional, where there is no actual outflow. So cash break-even point in value, and break-even point total sales minus the margin of safety. This we will discuss later on. I told you in the last lecture also this we are going to discuss later on. So if anything which is less than the break-even point, will be incurring losses because we will not be able to cover the fixed cost, and anything above break-even point we will have the profits, because at the break-even point we have already recovered our fixed cost, right? So this is all what we discussed about the break-even point. So in this lecture, what we are going to do is we are going to do some practical problems. I gave 4 practical problems as homework also. So all those practical problems we are going to discuss. We are going to solve each and everything, right? And after that, we'll have to discuss one topic, that is multi-product break-even analysis, because we have a question in the ICAI module also. And one very important thing regarding the ICAI module, our ICAI module series for May 2022 attempt as per the revised edition with all the questions that have been added is available on our Android mobile app, and it is available in English. So if you want to take the real benefit in which we have discussed all the things in detail for May 2022 attempt as per the revised edition, right? So guys, go for that series. That is absolutely brilliant series. You are actually going to get a lot of benefit out of it. A value course, I can say, a value course, right? It is a recorded session of the live classes. I conducted the live sessions for December 21, in which I covered this May 22 module also. December 21 also and May 22 also. So both the modules are covered, right? So it is, I can say, the most valued course, right? So just go for it. Watch those lectures, cover ICAI study mat in such a way that you will have an absolute brilliant hold, right? All the links for Android app, everything, Telegram, given in the video description. Check out that. Important. And follow us on Instagram. That is again very, very important. Don't forget to. Okay. Now coming to the questions part. Let's start with question number 3. Selling price selling price per unit is rupees 10, variable cost is rupees 6, fixed cost 2000 in rupees, actual sales, this is per unit given. Then you have the fixed cost 2000, actual sales in rupees 20,000. Fixed cost include depreciation of 300 rupees. This fixed cost of 2000, it includes a depreciation of 300 and the deferred revenue expenditure of 100. Right? Calculate break-even point in units, break-even point in value, and break-even point in percentage, and cash break-even point. So all this you need to calculate. Let's do it, sir. No problem. So we'll solve question number 3 first. So what is the first part? First part is break-even point in units. So this is the first thing that we need to calculate. What is break-even point in units? Quickly, this is fixed cost divided by contribution per unit. What is the fixed cost given in the question? The fixed cost is given as 2000 rupees. Okay, sir. 2000 divided by contribution per unit. Selling price is given, variable cost is given. So selling price per unit minus variable cost per unit will give you contribution per unit. So I will write it as 10 minus how much? It is 6. 10 minus 6 multiplied by 100. No, sir, it is not in percentage. We are calculating the units. Right? So it is 2000 divided by 4. Right? So this comes out to 500 units. Clear, sir? Any doubts in the break-even units? Easy? Okay. Now, let's calculate the break-even point in value. Second, we have break-even point in value. Now we'll do it by the various ways. Let's do it by the various methods, right? We have already discussed the various methods. Let's do it by the various methods. So the first way of doing is break-even point in units multiplied by selling price per unit. Break-even point in units, you have calculated how much? 500 multiplied by selling price per unit, that is given to you in the question, that is 10 rupees. Right? So your break-even point in value is 5,000 rupees. Clear? Any doubts in this thing? Right, sir. So this is one way of doing it. Right? This is one way of doing it. Let's come to another way. The answer, you will get the same answer, don't worry. Another way is fixed cost divided by contribution per unit, right, multiplied by selling price per unit. What is fixed cost? Fixed cost is 2000 divided by contribution, that is 4, multiplied by selling price, that is 10, right? So you will get 5,000 rupees. Clear? So this is the second part. Now let's come to the third one, third way of doing it. So I'm telling you why this I'm solving it by all the methods, because in the examination, you can do it by anyone depending upon the information or depending upon your convenience. You should learn to know that how one question can be done in the different ways in marginal costing. That is why I'm telling you the different ways of doing it. Right? You people should learn this thing, that how one question can be tackled in the various ways, in the different ways, right? Okay, third way is, what is the third one? Third one says fixed cost divided by PV ratio, right? So that means we'll first need to calculate PV ratio here. What is PV ratio? PV ratio is contribution divided by sales multiplied by 100, isn't it? So contribution is 4 rupees divided by 10 multiplied by 100. So that comes to 40%. So in here we can say 2000 divided by 40%, which again comes to 5,000 rupees. right? So the answer will be the same in all the cases. What I am telling you is how to deal with the question, how a single calculation can be done in the various ways, right? How a single calculation can be done in various ways. Any doubts in this thing? I hope it is clear. Okay, let's move on to the next one. So next one says you need to calculate the break-even point. Break-even point is to be calculated in percentage. So this will be break-even point. I'll take it in value. You can take it in the units also, right? Divided by sales in value, multiplied by 100. You can try it out by the units also, right? So break-even point in value we have just calculated as 5,000, and the sales given to you. The sales are given in the question. Value sales is 20,000 rupees given to you in the question. So 20,000 multiplied by 100. So this comes out to 25%, right? So you can do it by the units also, no issues. Now, what is the next requirement of the question? We have done by units, we have calculated by value, we have calculated in percentage. The next requirement is to calculate the cash break-even point, right? So now here they have not clarified that whether you have to calculate the cash break-even point in units or you have to calculate the cash break-even point in this value. So you calculate it by both the ways. What is the issue, sir? We'll calculate it by both the ways. So fourth is cash break-even point in units. So in this case, what we are going to take is, instead of fixed cost, we take cash fixed cost. Cash fixed cost divided by contribution per unit. Now, what is cash fixed cost? Total fixed cost is 2,000, out of which 300 is the depreciation, which is notional, and 100 is the deferred revenue expenditure, which is again notional, right? Minus 300 minus 100 divided by contribution per unit is 4 rupees, right? So what you will get here is 400 units. Sir, what about the cash break-even point in value? What is the cash break-even point in value? If you want to calculate in value, you will say 400 units multiplied by the selling price per unit, that is how much? Selling price is 10 rupees, 10, right? So 4,000. Clear? So this is the cash break-even point in units also and in value also. Clear? So this is how the questions are to be solved. Okay. Question number 4. Let's quickly read question number 4. I might give you as homework. The selling price per unit is rupees 100. The variable cost is rupees 4. No issues in that. So from here we will get the contribution 6, right? Fixed cost is given as 35,000. Calculate the new break-even point in each of the following cases. If the selling price is reduced by 20%, that means now your selling price will be 8 rupees. Your variable cost is 4. So your contribution will be 4. Fixed cost is there. So fixed cost divided by contribution per unit. You will get the new break-even point, right? So I'll give you the answers for this. Try once. You will be able to do it. I know you people are genius. You people will be able to do it, sir. So the new break-even point in the first case will be 70,000, right? And in the second case, if the variable cost is decreased, what will be the new break-even point? It is going to be 50. After that, C part, if the fixed cost is increased by 20%, so the answer will be again 70,000 in this case. And in the last case, that is D part, says the selling price and variable cost are decreased by 20-25 and fixed cost is increased by 20%. So in this case, the answer will be 67,200, right? So try on your own once. Try to do it on your own. Let's move on to question number 5. The cost of production of a product per unit is as follows. Direct material 5, direct wages 4. Production overheads total is 5. Out of this, 40% is fixed, right? That means 2 rupees is fixed, right? And the 60% is variable, that is 3 rupees is a variable cost. Administration overheads total fixed, right? So total is 15. The figure given above are based on the output of 1 lakh units, right? So all this information is for 1 lakh unit. The selling price per unit is 20. What is the break-even point? Now for break-even point, what you need? One thing you need is the fixed cost, right? In the fixed cost, you will take the administration and 40% fixed cost from production overheads. Another thing you need is contribution per unit. For contribution per unit, you have the selling price 20. You will calculate the variable cost. These direct material, direct cost is always your variable cost. Remember, I told you in the very first lecture of marginal costing that when we talk about the direct cost, because it is identifiable in 1 unit, it varies with 1 unit. So it is a variable cost, right? So from using this variable cost and selling price, we will be able to calculate contribution. Okay, let's do it. Don't worry. Question number 5. So first thing that we need is fixed overhead. So first we will talk about fixed overheads, right? Fixed overheads is sum total of two things. One is administration, another one is production overhead. So I will say fixed overheads is equal to admin overheads plus production overheads, right? Fixed overheads is equal to this. So what is administration overheads? 1 rupee for per unit. How many units? 1 lakh units. So I'll say 1 lakh units multiplied by 1 plus production overheads. Production overheads are 5, but out of that only 40%, that is 2 rupees is fixed, right? So I'll write 1 lakh units multiplied by 5 multiplied by 40%. Clear? So this will give me fixed overheads. So fixed overheads here will be 3 lakh. Right? Now, second thing, what is your variable overhead per unit? One second. We'll write it in a different way. We'll say the second thing that we need is contribution per unit. Contribution per unit, right? Contribution per unit is selling price per unit. Selling price per unit minus variable cost per unit. What is selling price per unit in this case? Selling price per unit is given to you as 20 rupees. No issues. Sir, what about the variable cost? Variable cost is 5 rupees for the direct material, 4 rupees for the direct wages. Isn't it? And anything about the administration overheads? No, sir. About the production? Yes, 3 rupees from the production overheads, right? So 5 plus 4 plus 3. Plus 4 plus 3, right? So this will give me the contribution. This is 12, 8 rupees. 8 rupees is your contribution per unit. So from here, you can calculate the break-even point in units and in value also, as you wish. So what is your break-even point in units? Break-even points in units is fixed cost divided by contribution per unit, right? So what is your fixed cost in this case? Fixed cost is 3 lakh divided by contribution per unit is 8. So 37,500 units, right? And what about the break-even point in value? Break-even point in value, it is break-even point in units multiplied by selling price per unit, right? So 37,500 multiplied by 20, that comes to 7,50,000 rupees, right? So this is how the question is to be solved. If you can solve it in some other way, you can do it. There is no issues in that. If you want to solve this sum by any other way, you can do it. If you find that this sum can be done in a different way or using some different formula, you can do it, right? Answer will be same. Even if you are using the different formulas in marginal costing, the answer will be the same, right? That is one thing important. Now, coming to question number 6. Calculate break-even sales from the following information. Total sales 20,000, 30,000. Total cost is 17,600 and 21,600. Okay, now sir, tell me. Break-even point. Fixed cost. Sir, where is fixed cost? Not given. Total cost given. Total cost includes the fixed and the variable cost both. How we can separate it then? Right? Second thing that we need is the contribution per unit. For contribution, the sales is given, but where is the variable cost? Now, sir, this is problematic, sir. This is problematic. How can we calculate the break even from this part? Not possible, sir. Not possible. Right? So many of you will say, sir, not possible, sir. How can we calculate it? Absolutely not possible. It is possible. Let's do it. Let's see how is it possible. Right? Let's see how is it possible to do it. Question number 6. That is what we are here, to learn the things. First we'll write what is given here. Year 1, right? And year 2. Okay, so sales is given and the cost is given. Total cost. Sales is given 20,000 and 30,000. Great. After that, cost is 17,600 and 21,600. Now, what is the thing that you can calculate? What is that you can calculate from total sales and total cost? What can you calculate? Sir, you can calculate profit from here. You can calculate profit from here, right? If we say it 1 and 2, so 1 minus 2 will give you profit, isn't it? So 20,000 minus 17,600, 24 will be 2,400 is your profit in this case. Any doubts in this thing? Right? And here you will have a profit of 8,400. Right? So profit we can calculate. Great, sir. We have the profit now. Sir, what to do with the profit? We need contribution per unit and we need fixed cost. Anything else you can need? Sir, we can also solve it by fixed cost divided by PV ratio, because he's asking for the break-even sales. He's not asking for the units or the value, right? So if we calculate in the value, I can calculate using the PV ratio also. Now, whatever the information is there on your screen, can you tell me, can we calculate PV ratio from such information? Is there anything we have studied in the PV ratio like change in profit by change in sales? Something like that we studied in the PV ratio or not? Whatever the information is right there on your screen right now, can you calculate PV ratio from there? Absolutely yes, sir. We can calculate PV ratio from here. So the first step will be to calculate PV ratio. Right? PV ratio is change in profit due to change in sales. So divided by change in sales multiplied by 100, right? So what is change in profit, sir? 8,400 minus 2,400 divided by change in sales, that is 30,000 minus 20,000 multiplied by 100, right? So this comes out to 60%. Now my PV ratio is 60%. Correct, sir. Now, if you want to calculate the break-even sales, we can calculate it using fixed cost and PV ratio, isn't it? We can calculate it using the fixed cost and the PV ratio. So PV ratio, we have got it, sir. Now, how to calculate fixed cost? How to calculate fixed cost, sir? Sir, what is the meaning of PV ratio? If we say PV ratio is equal to 60%, that means contribution, I can write it as contribution is equal to 60% of sales. Isn't it? One very important thing here is that whatever is going to be your fixed cost, it is going to remain constant between year 1 and year 2, right? Fixed cost will be same. Fixed cost will be same, isn't it? The fixed cost will be same, right? So let's take up the sales of the first year. So if you want to calculate the contribution, I can say contribution is 60% of sales of the first year. What is the first year sales? 20,000, right? 20,000. So your contribution is 12,000. Profit for the first year. Profit for the first year, sir, 2,400. Now tell me, if you have contribution and if you have profit, can you calculate fixed cost? Can you calculate fixed cost is equal to, remember the income statement, sir, remember the income statement. See, if you have contribution and if you have profit, can you calculate fixed cost? Right? Minus 2,400 is equal to, fixed cost will be rupees 9,600. Now we can calculate break even, that is fixed cost divided by PV ratio. We can do that? Yes, sir, we can do it. Break even point in value, that is fixed cost divided by PV ratio. 9,600 divided by 60%, right? So this comes out to rupees 16,000. Clear? So this is how this question was to be solved. Interesting, isn't it? See, the question seems to be very small one. If you see the question, sir, this much of a question only, but even this much of a question can create a lot of confusion, right? By the question, it seems like, oh, this much of a question, it's very easy. What is it? Nothing, right? But when you look at the solution, you look deep into this, you will find out that there are a lot of calculations to be done, right? Ultimately, first you will have to think that how it is to be done. First we calculated profit, then we calculated PV ratio, then we calculated fixed cost using contribution and profit, then the break-even value. Right? Any doubts in this thing? So we are almost done with the break-even point. We are done with question number 6 also. Now coming to one last topic quickly. That is there in the ICAI module also. That is multi-product break-even point. That is multi-product break-even analysis. So this is the last topic for break-even point. Multi-product break-even point. Break-even analysis, I will say. Now, what is this multi-product break-even analysis? Let's say you are selling two products, right? Let's say you are selling product A and you are selling product B. And in this, your sales mix, that whenever you are selling this product, you are selling 5 units of A, and in ratio to the 5 units of A, you are selling 3 units of B. This is known as sales mix. Right? This is known as sales mix, that if you are selling, that whenever you are selling 5 units of A and correspondingly you are selling 3 units of B. Right? And I say contribution is 40 rupees and 20 rupees. Right? This is the contribution that the products are giving, right? And the fixed cost is given as rupees 6,16,000. Now, what is the problem? They say calculate break-even point. Calculate break-even point of A and B. Sir, what is the problem in this case? Now listen to it very carefully. Sir, when we calculate break-even point, we say fixed cost by contribution per unit, right? Here, the fixed cost of 6,16,000 is given as combined for both the products A and B, whereas the contribution is given separately for A and B. How will you calculate the break-even point separately? That means you will have to divide the fixed cost. One way of doing it, right? You will have to divide the fixed cost and then calculate the fixed cost by contribution per unit, right? So this is one way of doing it. Another way of doing it is you calculate a composite contribution rate, then calculate the total break-even point, then divide the break-even point. For example, okay, now I'll do it by method 1 first. Try to understand method 1, what we are doing it in method 1. Method 1. Just listen to it very carefully. I say that there are 2 pizzas, right? I'm taking a pizza here, right? I'm dividing it into 8 parts, 8 slices, right? And this is pizza A, right? And there is another pizza again, which is pizza B. I'll divide it into 8 slices again, right? Now what I say, that a customer comes to me and he says that please give me a mix of A and B. That I want a mix of A and B, right? Now this pizza A has 8 slices as given. This has 8 slices, right? 8 slices. This also has, I'll remove this word slices, just remember it, right? This also has 8 slices. The contribution from this product, if you sell this whole pizza, your contribution will be 40 rupees. And if you sell this pizza B, your contribution is 20 rupees. Isn't it? This is as per the question. I am saying that there are total 8 slices in pizza A and pizza B. Now I go to this shop. I say that I don't want a complete pizza. I say, do one thing. Give me 1, 2, 3, 4 and 5. 5 slices. Give me 5 slices of this pizza, right? And 3 slices of this pizza. 1, 2 and 3. So this is the combination that I want. Now that pizza boy, he was actually startled. But he says, okay, sir, because customer is, you can't say no to the customer. Customer is God, sir. So I told him that I don't want a complete pizza. Just give me 5 slices of pizza A and 3 slices of pizza B. Now tell me one thing. If I talk about this pizza A, right? If I talk about this pizza A, what I am doing is from 8 slices, I am earning a contribution of 40 rupees. But now if I am selling 5 slices, if I am going to sell 5 slices, what is the contribution that I will be earning? What is the contribution that I will be earning? That is 25 rupees. Isn't it? Here, in this case, what will happen in this case, sir? From 8 slices, they're earning a contribution of 20 rupees. Now, if you are selling 3 slices, what will be your contribution? 20 by 8 multiplied by 3, that is 7.5, right? So by selling this combination, that 5 slices from pizza A and 3 slices from pizza B, what will be the total contribution that will be earned? If I talk about the total contribution now, total contribution earned from these 2 pizzas, right? This is my product A, this is my product B. What is the total contribution that is being earned? That is 25 plus 7.5 is equal to 32.5, right? This is known as composite contribution. We call it as composite contribution. Composite contribution, or we call it as weighted average contribution. Weighted average contribution. Clear? Now what you have is fixed cost 6,16,000, combined contribution 32.5. Now you can calculate what we call it as composite break-even point. Composite break-even point. That is the total break-even point. Fixed cost divided by composite contribution per unit. Right? So fixed cost is 6,16,000 divided by composite contribution is 32.5. Right? So this comes out to 18,950. This is rounded off, right? 18,950 units rounded off. It will be something 53 point something or like that. Now this is the total break-even point, but the question is asking to calculate the break-even point for A and B. Now what will you do is break-even point for A. You will divide this break-even point in this ratio. In 5:3 ratio, you will divide this break-even point. So break-even point for A will be 18,950 multiplied by 5/8. So units will be approximately 11843, I think, something like that, right? Rounded off. So break even, rounding off is allowed in the exams, guys. Don't worry about it, right? So rounding off kind of things are allowed. So break even point for B is equal to 18,950 multiplied by 3/8. That is 7106 units, right? So you can take here 4. Take here 4. No issues. Clear? So this is one way of doing it. I have explained you with the help of this pizza slices so that you are able to grasp the thing what we are trying to do. Basically, we are calculating the weighted average on the basis of the number of slices that you are taking. That is the weight. So average of that weight, right? So we are taking the weighted average basically. This is how it is to be done. Now come to methodology number 2. What is number 2, sir? Let's discuss about method number 2. Very simple. What I'm saying is I have two products A and B, right? Sales mix is 5:3 and contribution per unit is 40:20, right? Now I'm saying that you are selling 5 units, right? And you are earning a contribution of 40. I say this is one bundle. This is one bundle. This is one batch basically. This is one batch. I say you are selling 5 products and you are earning 40 rupees per product. So what is your total contribution? Contribution to sales, right? According to the sales ratio, we call it as contribution to sales ratio. Contribution to sales. That if you are selling 5 units, your contribution per unit is 40. So total you are earning 200. And if you are selling this product B, you are selling 3 units and 20 is the contribution per unit. That means total contribution is 60. Now he says it is contribution in the sales mix. Fixed cost is given to you as 6,16,000. Fixed cost is given to you as 6,16,000. They say divide this fixed cost in this ratio. In 200:60, divide the fixed cost in this ratio first. Right? So in that case, what will happen, sir? In that case, your fixed cost for A, for product A will be 6,16,000 multiplied by 200 divided by 260. That comes out to 4,73,846. These are all rounded off figures. Fixed cost for B is 6,16,000 multiplied by 60 divided by 260. That comes to 1,42,154. Now, you need to calculate break-even point. For break-even point, you need the fixed cost and contribution per unit. Sir, fixed cost for A is available. Contribution per unit for A is available. 40 rupees. Fixed cost for B is available. Contribution for B 20 is available. So you can calculate the break-even point. Simple, right? So break-even point for A will be fixed cost. Fixed cost is 4,73,846 just calculated. Contribution given 40 rupees. So 11846 units. Similarly, the break-even point for B is fixed cost of B, that is 1,42,154 divided by 20 rupees. That comes to 7107 units. Right? So this is how the break even for the multiple products, where you have the multi-product break even. These are the two ways in which you can calculate. Right? So we have calculated the break even for product A also and for product B also. Now be careful in one thing. If the question says that you have to calculate the overall break even point of the firm, right? The question says you have to calculate the overall break even point also. In that case, you will have to apply method 1 only. In that case, apply method 1, right? In case you are asking for the break even point for the individual products, then you can apply any of the methods that you wish to apply, right? So we are done with this break even part, break even point. I hope you people have understood it very well, right? And in the next lecture now, what we are going to start with is, next lecture will cover margin of safety. Margin of safety, and maybe we'll cover angle of incidence along with this. We'll see according to time, right? Margin of safety and angle of incidence. Break even point is over from our side, right? So revise it properly, right? Prepare it thoroughly. Nothing to worry about it. It's pretty simple. Just focus on the concept. So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.